No, it's not problem because when
Okay.
studying the conference, it will ask you many questions. That do
But
you want to record? How long do
it's
you
done,
want?
it works now. It's okay. But where is the button to share the screen?
Yeah, I will give you.
Afterwards, I will
No,
not
you
ask
can
you
try.
anything. I will. Ah, okay. Okay. Partager. So now we have only people are joining progressively. So we have to.
Yeah. Let mình ơi, các bạn Hồ Chí Minh ơi, các bạn nhắc các bạn vào lại conference khác của em với, vào lại cái invite mà em vừa gửi ạ. Cái conference kia là thầy tạo, thành ra là thầy lại không có cái nút record.
So we have 14 people.
Yeah, give them 5 minutes to
Yes.
connect.
Yes. Okay.
Sorry, dear, I'm just some Vietnamese with student about the new link.
Am I on the right session or not? No. I suppose so.
Yes, you're on the right. You are in the right rooms.
Okay. So we are going to start now, no? It's okay?
Yeah.
Okay. So thank you, Lynn. So I suppose that you can listen to me and you can see me. So I'm going to introduce myself firstly. Then I will present to you the course, even if the announcement has already been done by Lynn. And then, of course, in the 5 coming minutes, we will enter into technical details. So, of course, please don't hesitate to interrupt if you have questions. You can do it directly without using the chat. If you prefer using the chat, you can, of course. But I prefer to have directly the questions. So first of all, as you know, because it's written down on the laptops, my name is Olivier Levin. I have studied in a French business school during the last century between 1986 and 1989. After 2 years of preparatory school, the name of this business school being le SCP, l'École supérieure de commerce de Paris. I have mostly studied with somebody you know, with a professor Alain Chevalier, who made me enjoy finance. I also have a PhD in economic science and an habilitation to supervise research in management science. And I have spent all my professional life so far in the private sector. I mean that I have a very long experience in investment banking. I started in a firm with the name of which was Clinvest, which was the M&A arm of Crédit Lyonnais. And I worked at Clinvest till 2004, because in 2004, Crédit Agricole, which had launched a tender offer on Crédit Lyonnais, decided to merge the investment banking activities, including Clinvest, of Crédit Lyonnais with Crédit Agricole Indosuez. And after that, we had a new entity, the name of which was initially Calion, then CACIB. And between Clinvest, historically, then CACIB, as usual in that kind of industry, if I may say, I have successively been an analyst, an associate, a VP, a director, an executive director, and finally, a managing director in charge of the financial institution sector, which means that I have advised many transactions, M&A transactions, but also ECM operations regarding banks and insurance companies. The very last thing I have to say that I've always spent some time, I should say a lot of time, on teaching activities historically at ESCP till 2005. Then I stopped because there have been many strikes in France in 2005. It was impossible for me to reach the ESCP. And at the same time, I had the opportunity to become a professor and an affiliate professor at HEC Paris. And I came back to ESCP 4 or 5 years ago. So this is what I wanted to say regarding my personal curriculum. Regarding this course, I have been asked by Professor Alain Chevalier to present 3 main topics, which will enable normally to capitalize on what you've seen probably with him or with other professors in these courses. We will start dealing with financial institutions today. We will not finish today. We will need at least another course, namely on Wednesday, if I'm correct, because tomorrow there is no course. I have other commitments. Then I'm going to show anyway, I've prepared that, the syllabus you have on the system. So first of all, investment banking for financial institutions. Then, as I was about to say, leverage buyouts. I mean, M&A transactions involving necessarily a private equity fund. I mean, a private equity fund or a financial sponsor needs such a high internal rate of return, and the only possibility for them is to structure a leverage buyout. And this is what we will see in details. And Alain also asks me, because he knows that I'm very familiar with that, to deal with you with real options, namely the use of option pricing models you've seen in other courses, such as Black-Scholes or Cox-Ross and Rubinstein, applied to the solving of corporate finance issues, including valuation. Okay, so 3 main parts. And for today, we will start with investment banking. From a practical point of view, I am used to writing down most of what I'm saying. I will do that on a software, the name of which is OneNote. No issue if you do not have OneNote on your laptop. I will share my screen, and at the end of the course, I will send to everybody, I will put on the system all what I will have written down. It's the first point. The second point, from a practical point of view, is that I will present some finance principles, unamazingly, but we will systematically practice on real situation, on real figures, on real corporate entities or financial institutions. I mean that we will dedicate, as soon as today, a lot of time on finance modeling. Of course, I will share my screen. Of course, I will send the model at the end of the course, but it would be great, and normally it's possible to do so, that you do it simultaneously on your own laptops, because the best way to master principles is to do it simultaneously. And moreover, to terminate, once the model is finished, I copy and paste what we've done together on slides with the required, according to me, explanations in an investment banking style. I mean that I will present slides as I would do if I was to pitch a client. This is the way we will proceed. Do you have questions, or can we start? Of course, I can see many things in the chat, but if it is for me, please do it in English. I do not understand the Vietnamese, of course. No question, we can start? I hope so. Just to be sure, can you hear me? No problem? I can see that somebody is writing down, so it seems to be okay, even if it's not already on the screen, but yes, that's perfect. So please don't hesitate to interrupt if necessary. Okay, so as you can see, we are going to start with investment banking for financial institutions. And we will deal with valuation today. Okay, so as you can see, we are going to start with the solvency constraints, which is probably what you've seen with Alain Chevalier. I don't know in which level of details you've entered with him, but anyway, I will provide the required refresher, and then we will move to valuation of that kind of entity. So I would like to start with the solvency constraints. Do you know what the constraints are? No? I mean that we could say each country has its own constraints. Normally, the constraints could be the same ones for all the financial institutions in the world. It was the initial goal. If you do not have questions, please put on mute, otherwise we can hear a strange noise. If you can put on mute. Okay. So I mean that when we are dealing with banks, when we're dealing with insurance companies, there are some constraints, some solvency constraints. And for today, we're going to focus on banks. It will be enough. And you may have seen, I hope I didn't do something wrong, but normally I have put on the system some financial information on Société Générale, which is one of the 3 main listed universal banks in France, and I could say in Europe. So I'm going to explain the principles of solvency constraints, okay? And then we will use that from a practical point of view, okay? So I'm going to use this software, which is OneNote, which is very comfortable to write down, okay? I'm going to do that way, and I'm going to deal with A corresponding to solvency constraints. So I'm going to write more properly. It's only the beginning, constraints. So what I want to say regarding the solvency constraints of a bank, I'm going to write it down for banks, is that it's something which is relatively new. I mean that before 1988, people were not used to hearing about solvency constraints for banks. But in 2008, there has been a crack on the stock exchange, which boiled down to many bankruptcies of saving banks in the US. And as usual, problems occur in the US, and the constraints are decided outside the US. I mean that it's been decided that banks had to have a minimum level of equity when they undertake a risk. And I have to say that the main risk for a bank is relative to credit. I mean that if you grant a loan to a client, it may be a corporate client or a retail client, there is always a risk that the debt will not be repaid. So I mean that it's been decided in 1988 that a ratio would have to be respected by financial institutions. This ratio was created, if I may say, determined by the deputy governor of the Bank of England, the name of whom was James Cook, and this is why we speak about the Cook ratio, which was supposed to be applied from 1983 onwards. And the principle of this Cook ratio, which is a solvency ratio, is that you divide the equity by what we are used to naming the risk weighted assets. The risk weighted assets. And for reasons I do not know, honestly, it's been decided that this Cook ratio or the solvency ratio had to be minimum equal to 8%. I have to say that this ratio was decided during a weekend, and on Monday morning, the chairman of the various banks in Europe asked their CEOs to calculate the ratio. The CEOs asked their CFOs to calculate the ratio. The CFOs asked the head of accounting department to calculate the ratio. And at the end of the day, somebody had to calculate the ratio. And at the end of the day, it's been realized that for the French main banks, Crédit Lyonnais at that time, or BNP, the ratio which was obtained was between 3 and 4%, which means very far from 8%. Okay, so amazingly, instead of changing the threshold, instead of deciding that the ratio had to be minimum equal to 4 or 5%, it's been decided to change or to specify the definition of the ratio. First of all, it's been said that the equity was a consolidated equity. It was probably a no-brainer, but it was definitively said. If we say consolidated equity, it means including minority interests. So I'm going to write it down here. I'm going to put a footnote to say including minority interests. But even if you include the minority interests of the various banks, it was not enough. So as I had an idea, I would have never found, never. You have to be the deputy head of the Bank of England to think about that. They decided to include debt in equity. Personally, I would have never thought about that. And they've said that, in fact, when we speak about this ratio, we can say that we have the tier 1 plus the tier 2 over risk-weighted assets, which had to be at least equal to 8%. What is tier 1? Tier 1 is more or less consolidated equity. Sorry, I'm going to write more properly. Consolidated equity. But there is a but. But in fact, it's not a consolidated equity. I could say it is a tangible equity, which means that you have to deduct intangible assets, for example, softwares, and you have to deduct the goodwills. I mean that we have in mind, when we calculate such a ratio, that equity is indeed the difference, as you know, between assets and liabilities. But if you were to liquidate the firm, you wouldn't be able to sell the intangible assets. And of course, you would not be able to sell the goodwills. So you have a kind of tangible equity. Okay? And at that time, it was more or less the definition of the tier 1. It's written down on the top. And regarding the tier 2, it was only made of subordinated debt. So, you have to know, it's not necessarily a no-brainer for everybody, that for a bank, it's very easy to raise debt. It's very easy to raise subordinated debt. So if it's so easy to raise some subordinated debt, there is a risk that the ratio is only made of tier 2, is only made of subordinated debt. This is why it's been decided that the tier 2 was capped to the tier 1. It doesn't mean that you can't raise more subordinated debt than you have equity, but it's not recognized as tier 2 beyond the level of tier 1. I mean that if your tier 1 is equal to 100, you can raise a subordinated debt for 150, but you will say that your tier 2 is only 100. So if it is that easy to raise subordinated debt, except in times of crisis, of liquidity crisis, as we've seen in the world after the bankruptcy of Lehman Brothers in 2008, all the banks decide to have a level of tier 2, which is equal to the level of tier 1. So for banks, for most banks, tier 2 was equal to tier 1. So in fact, the ratio which is there means 2 times tier 1 over risk-weighted assets has to be higher than 8%. Tier 1 plus tier 2 being equal to tier 1, you have 2 times tier 1 over risk-weighted asset, which is 8%, which means that tier 1 over risk-weighted assets, I'm going to write it more properly, which means that tier 1 over risk-weighted assets had to be higher than 4%, which was in fact the main constraint. I didn't say anything so far regarding the risk-weighted assets. I have to say regarding the risk-weighted assets that we have here mostly the loans granted to clients. And at that time, when the ratio was defined in 1988, the weighting coefficients were the following one. First of all, loan to the state, 0%. Loan to a bank, 20%. Loan to a corporate or to an individual, 100%. So I mean that if a bank was granting to you or to me or to Bernard Arnault or to Jeff Bezos or to one of the richest person in the world, the weighting coefficient was exactly the same one. For corporate, it was the same. I mean that you can grant a loan to Microsoft, to Google, to Tesla, or to a SME. The weighting coefficient in this solvency environment is always the same one, which is completely ridiculous. I mean that the risk of bankruptcy for an SME is meaningfully higher than the risk of bankruptcy of Apple, of Google, of Tesla, or whatever firm you want. Let's say that this ratio corresponds to what we are used to naming the Basel I environment. In the Basel II environment, which was decided about 20 years later, in the Basel II environment, it was decided that the risk-weighted assets were a function of the probability of bankruptcy, if I get to write it down, of bankruptcy. I mean that the weighting coefficient for an SME is not exactly the same one. I mean, it's meaningfully higher than the risk of bankruptcy, and therefore the coefficient is more important than that for LVMH, which is the undisputed global leader in the luxury industry, or Microsoft, or Amazon, or whatever, very well-known firm. So this was decided. Okay, I mean that each firm has, each borrower, I should say, has its own weighting coefficient. And after the bankruptcy of Lehman Brothers, there have been new constraints which have been decided in what we are used to naming the Basel III environment. And in fact, in the Basel III environment, we do not say tier one. Of course, there is a tier one ratio. But everybody now is focused on the common equity tier one. I mean that in this tier one, I'm not going to enter into details because it's not very important to have in mind what we were calculating 25 years ago. What's important is to know how we do nowadays. Okay, but in this tier one ratio, I mean that deeply subordinated debt, super subordinated debt was eligible to tier one. Nowadays, I mean that we say that the common equity, I'm going to write more properly, common equity tier one over the risk-weighted assets corresponds to the CET1 ratio, common equity tier one. What is the threshold? I can tell you. It depends on the banks. I mean that normally when a country decides to abide by this regulation, every quarter the CFO of the bank receives a call from the head or the deputy head of the central bank saying, well, for last quarter, your bank had, let's say, 10% common equity tier one ratio. For next quarter, you can do whatever you want, but we want this common equity tier one ratio to be 10.25% or 10.5%. Okay, so it depends on the banks. If you look at, we'll see that in the coming minutes because we will do some financial simulations. If you look at Société Générale, you will see that they are at about 13.7%, if I remember correctly. So I mean that for main banks, okay, it's more than 11%. So we are very far from the 4% we had in the Basel I environment. Okay, I mean that the constraint, for example, for UniCredit on the one end, for Deutsche Bank on the other end, for Morgan Stanley in the US, for Crédit Agricole, for BNP Paribas, for Société Générale in France, are different. Each bank has its own constraints, but there is one thing which is sure, which is that once you've reached a ratio, you have to do better, to do more in the next quarters and years. So I mean that we have a conservative view if we say that today the common equity tier one ratio, for example, is 13%, and it will still be 13% in the future. So I mean that we have to keep that in mind. This is the first point I wanted to say as an introduction to the solvency constraints. And there is a point which has to be said beyond that. What's happening if the ratio is not respected? I mean that you're asked to have a 13% ratio and you get 9% because you've posted a huge loss. What's happening? I mean that if it's the case, you are no more authorized to gather deposits from clients I mean that you simply, it's easy to say, you simply lose your banking license. And what's happening after that? A bank run. I mean that all the clients of the bank are running to the bank in order to get their money back. Okay, so I mean that it is a dramatic constraint for banks. They know that if they do not cope with the regulation, they can't exist anymore. So it's so important for them that this has to be included in the valuation process. Okay? And it's the more important to keep in mind that it's included in the valuation process as the DCA evaluation approach you've studied in another course can't work for a bank. Personally, I can see the way to calculate the free cash flow of a bank. I mean that you've seen, probably, not probably, for sure, it's been said to me by Professor Alain Chevalier, that the free cash flow is a net operating profit after tax plus the D&As plus the net capex less the change in net working capital. Personally, I don't know what the net operating profit of a bank is. Personally, I do not know what a net working capital for a bank can be. Personally, I do not know what the net debt of a bank to be deducted from the enterprise value is. So, I mean that the DCA valuation approach doesn't work. So we need to find something else. Okay, this is what we're going to see. So first of all, I wanted to say that there is a constraint, which is a common equity tier one over the risk-weighted assets, which include the probability of bankruptcy of the borrowers, and this common equity tier one ratio has to be taken into account in the valuation process. This is what we are going to see. I will not say anything more regarding solvency because it's enough in order to deal with valuation. So if I come back from a few seconds on the table of contents, you can see here. Okay, so we've said that there are some solvency constraints. Okay, and in fact, you've seen some peers valuation approaches. And before dealing with the DDM approach, which for banks replaces the DCF approach, I would like to speak about the peers approaches, listed peers and M&A peers approaches, and to see which ratios are calculated, or multiples. A multiple is a ratio for banks. Okay, so we've said firstly solvency constraints, and now let's deal with peers valuation approaches. So I can see that it was I, okay, or small one. You see, instead of A, it was I here. And so now we have double I, which is dedicated to peers approaches. Approaches for banks. So normally, you know what a peers approach is. You know that you are, first of all, listed peers, and you have M&A peers. You know that in both situations, the great issue is that you need to find the peers. Listed peers is not very difficult. I mean that if you want to value a firm, it can be a bank, it can be a firm in metal and mining, in TMT, in healthcare, in hospitality, or whatever industry you want. You type the name on Google Finance, and you type peers, and you will have the list of listed peers. So it's very basic. And many peers, is a bit more complex. You need a dedicated database for that. Okay? And I have sent to you an extract of Capital IQ, which is a very well-known database for M&A. So you've seen in the past, and for the refreshers, everything will have been done, that first of all, you have to find the list of listed peers or M&A peers. Okay, I mean firms with the same prospects in terms of growth and operating profitability. The first point. Okay, so I'm going to write down the refresher and then we focus on banks. So first of all, I have to say identification of peers, i.e. firms with the same business model. And firm with the same business model means same prospects. When I'm saying same, I should say more or less, in terms of growth and operating profitability. And to write properly, profitability. Profitability. Then you calculate multiples, and you've probably seen, and I will not write that down because it's not appropriate for banks, EV to sales, EV to EBITDA, EV to EBIT. But what are sales for a bank? I don't know. You could say it's a net banking income sales, but it's not exactly the same as the sales of a corporate entity, and nobody is calculating a multiple of sales or multiple of net banking income. Multiple of EBITDA, EV to EBITDA, but what is the EBITDA of a bank? I don't know. EV to EBIT? No. In fact, you've calculated the P for a corporate. We can do that for a bank. So first of all, we will calculate the P, which is price over earnings per share, but we can also say market cap over net income. And the second ratio or multiple, a multiple is a ratio, as I'm used to saying, is the price to book value. Price to book value. When we say book value, I should say the book value of equity, which means that you take the market cap. I'm going to write it down here. Market cap over the book value of equity. So I mean that you have two main ratios, and you can also say, well, let's say the price to tangible book value, which means the market cap over the tangible book value, where the tangible book value to write properly, where the tangible book value is the book value. Okay, so shareholders equity group share minus intangibles and goodwill. So it's more or less a common equity tier 1. So in fact, you can say that we have A, B, and C, which means only 3 multiples. We are not going to build the sample of listed peers, because you've already done that in other courses. I'm going to provide to you what's already been done by Capital IQ, and I will spend more time explaining the discrepancies between the multiples. So please tell me if I can see that somebody has written something. I can see that Lynn wants to ask me a question. I'm to say yes. No?
I'm here. I'm here. Can you give 3 minutes or 5 minutes of break for students? And I will talk
No.
with you. I will
Right
talk with you for a minute.
Yes. Okay.
Yeah.
Okay.
Student, can you have a short break, 5 minutes? I will work with your professor a little bit. Olivier, can you check my email?
You sent an email.
Yes.
Sorry,
because
I didn't
now
look
you
at
share,
that.
because now you share screen, but it's very small. Can you choose to share the full screen, not the half screen like this?
Yes, I'm going to tell you why I did that. Of course, in fact, I divided my screen into two parts in order to be able to see the chat. Of course, I can.
Yes.
You can see I can put that. Let me do it.
Okay. I see now. Yes, it's perfect. Yeah, sorry. Sorry. So you manage that? I just think that you don't know that.
But
I can
do that. I can do that, of course. The only problem if I do that is that I can't see the chat anymore.
Yes. But like before, it's quite small. Student, can you see clearly?
Okay. They should have said it to me. So we can. It's better now, I suppose.
Yeah. Okay. So they are good for them. So I don't have problem. Sorry for that.
No. There is no issue. But the problem is that if they have questions, I can't see them. They have to say it verbally. They have to say, I can't see the chat.
Okay.
Okay.
Okay. I don't disturb you anymore. Sorry.
Okay. So what do I do now? Am I going to resume, or will I them 5 minutes?
No, I think you just give them some break because maybe some of them out.
So I wait for 5 minutes to go on?
Yes. You can take a coffee.
Okay.
Sorry again, Professor.
No. You are right. I'm only.
because
I'm
you
coming
are
back
the first time.
Just in order to see if there are questions, and I will say to them. I don't know if they can hear me.
Okay.
If they can hear me, that's fine. I would say that I'm going to.
I just want to make sure that you know that.
No, it's okay. It's
Sorry. Okay. Let's take a break.
Okay. So we say the first break, right? Okay. Okay, I can see what you sent to me. Yes. It's too small. So I have a 3-minute break. So I suggest that we go on. So in fact, I don't know if you could hear what Lina said to me. In fact, she asked me to share my old screen. In fact, I was writing only on the left so that I could see the chat. But I could see what you can see. It's too small, of course. So I'm going to share the full screen, but I can't see the chat. So if you have urgent question, please ask directly without raising hand, without typing anything on the chat. And of course, I will try very often to think about the chat and to come back for a few seconds on the chat. So it will be, of course, easier if I do. Way. So just a second. Okay. So of course, it should be meaningfully better if you can see that. So what you can see is that we have three ratios. In fact, the third one is a slight change compared to the second one. So we can say that we have mainly the P and the price to book. We are not going to waste 1 hour calculating P's or calculating price to books, which only consists in dividing a market cap by an aggregate, which may be the net income in the case of the P, or the book value of equity for the price to book. I have normally uploaded on the Canvas system the ratios or the multiple is the same for Société Générale and its peers. And I will comment on the ratios, and I would like to focus, after we've seen the ratios, after we've seen the multiples, on the explanations regarding the discrepancies between multiples in a given industry. So normally, and please tell me if it's not the case, normally I have uploaded in the system 2 or 3 documents. I will start, in fact, from this one. You can see this one, where you have a sample of listed peers for Société Générale. I didn't do anything, honestly. Everything is already done by Capital IQ, which is in the Standard & Poor's group. So you can see, first of all, that we want to focus on Société Générale, which is written down where I am putting the mouse. And you can see normally very well-known names. For French people, of course, Crédit Agricole, BNP Paribas. You have here Intesa Sanpaolo in Italy. You also have Unicredit in Italy. You have ING in the Netherlands. You have Lloyds Banking Group in the UK, which you can see is listed on the London Stock Exchange. And you can see that you have the Sumitomo Mitsui Financial Group, which is, of course, a bank which is in Asia. Okay, you have Santander in Spain, you have Standard Chartered also on the London Stock Exchange, and you have NatWest. So for each bank, you can see that you have the price per share, the number of outstanding shares. Maybe I should center all the amounts or multiples and so on. It will be easier to read. Okay, so you have the price per share, you have the number of outstanding shares, and you have the market cap. Okay, so figures may have been rounded, but of course the market cap is share price times the number of shares, as you can see. Okay, so it will be slightly different from what you have if I multiply, because figures which are after the first figure, after the point, are not taken into account in my calculation, whereas it is in the calculations you already have. But it's not the point, it's not very important. So you have the market cap, you have here the minority interests, and you have the tangible book value per share, which means the book value of equity minus the intangible assets and goodwills divided by the number of shares. It's an information which is provided to you. And as you probably know, in the finance world, we are used to putting in blue what's entered and in black what's calculated, which means that here it is also calculated. It is also entered. So here we have the revenues. Personally, I don't know what revenue means for a bank. I'm saying that, in fact, it is the net banking income, but we are not going to focus on that. You have the EPS, and you have again the revenues for the next 12 months. So you have the last 12 months, and here you have the next 12 months, okay? And you have the EPS for the next 12 months. So here you have the customary financial information for each bank. Okay, so I'm going to say that honestly, I'm not interested in the revenues of the bank, so I could hide this column for the sake of clarity, if I may say. Okay, okay, so honestly, I'm going to reduce the size of this column so that it's easier for you to see what's important and what's not important in this table. Okay, so here you have preferred shares, so the kind of debt anyway, you have the minority interests, and so on. So here you have the basic financial information on each firm, namely EPS, or if you multiply by the number of shares, you have the net income, and the tangible book value per share. And again, if you multiply by the number of shares, you have the book value of equity. So this is what I wanted to say regarding this table. I have to say that we have a second table. So I mean that here we have the identification of the peers, which is done by Capital IQ, which means that the vision of the market regarding Société Générale is that the peers, the listed peers, are there. Personally, reading that, I'm not really surprised. I might have added Deutsche Bank, but Deutsche Bank has experienced so many difficulties along the past 3 or 5 years that I can understand that it does not appear here. And here you have what we are used to naming the trading multiples. I'm going to reduce the size in order to increase the scale. You see, I'm going to do that way. Okay, and honestly, I can get rid of that. And normally, it should be okay for you to see. I do not need so. Okay, so what I want you to see, where in the trading multiples sheet, you can see that if you look at the price to EPS, which is the P, of course, okay, based on the last 12 months or based on the next 12 months, you can see that Société Générale is the lowest one. You can see that no peer has such a low P. I mean that the P's you have there, I could have written down is equal to P last 12 months, last 12 months P. I mean that no peer has such a low P. And if you take into account the next 12 months, for Société Générale, it's of course higher than the one which was based on the last 12 months. I mean that I know that 5.5 is higher than 3.9. On that point, I fully agree. But again, here, no peer has such a low P. So we are in the same industry. I can confirm that the activity of Société Générale, of BNP Paribas, of Crédit Agricole, of Intesa, and so on, are exactly the same ones. But there is a difference in terms of P. First point. Second point, before providing the explanation with the proof, of course, you can see, if you look at the price to tangible book value, that we are between here 0.5 and 0.8, 0.5 and 0.8, lowest 0.5, highest 0.8. And you can see that Société Générale, it has 0.3. So it's the lowest one. So how can we explain the discrepancy between two P's? And how can we explain the discrepancy between two price to tangible book values inside an industry? This is what I want to explain. Do you have an idea before I provide the explanation? Do you have an idea? I mean, a way to explain, for example, why Société Générale has a price to tangible book value which is 0.3, whereas for NatWest it is 0.8. Or a way to explain why Société Générale has a P which is 5.5, whereas ING has a P which is 8.59. How can we explain the discrepancies? Do you have ideas or not? Do you have an idea on the way to explain the discrepancy between multiples? No idea? No? I can see that there doesn't seem to be a question. So I'm going to provide the answer to my question. Okay, so we've said that we are here in the calculations of multiples, and I'm going to say now, focus on the discrepancy or discrepancies between multiples. So, first of all, I forgot to tell you that I will provide, after this course, a full handout on valuation, including what we've already seen in other courses. Okay, and there is only one page which is dedicated to financial institutions, but I'm thinking about that because I know that what I will detail is in my note. So focus on the discrepancies between multiples for banks. Well, not necessarily for banks, it's valid for the other industry. So you may have heard about the Gordon and Shapiro formula. I'm going to remind you that the formula of Gordon and Shapiro is V0 is equal to D1 over K less G, where D1 is expected dividend for next year, K is the cost of equity, and G is the perpetuity. I'm going to write properly perpetuity. Growth rate. And V0 is the share price. This is the Gordon and Shapiro formula. You can find it wherever you want on the web. I think that if you type Gordon and Shapiro Wikipedia, you will have the Gordon and Shapiro formula, as I wrote down, exactly with the same notation that is in all the finance books. I'm going to add another notation, which will be B, which will be the payout rate. B, which is the payout rate. Well, V0 is equal to D1. But what is D1? It is a part of the net income which is paid out to shareholders. When I'm saying expected dividend, it is per share because V0 is the share price. So I mean that the dividend is the part of the earning per share which is paid out. It is the earning per share times the payout rate. If I was saying that V0, instead of being the share price, was the equity value, I would have said that the dividends, the total dividends paid out by the firm would be equal to B, payout rate, applied to the net income. But here, as we are thinking about one share, V0 is the share price, okay? So D1 is the dividend per share. So we apply the payout rate B to the earnings per share in order to have the dividend. And I divide by K less G. Look what I'm going to do. I'm going to write down again what we have here without any change at this stage, but you can see that between there and there, I simply copied and pasted, but I'm going to say, well, nothing prevents me from dividing by EPS1 both sides. I think I can do it. And I have the great pleasure to tell you that V0 over EPS is the P, share price over EPS is the definition of the P, and of course, EPS over EPS simplified. And at the end of the day, and please tell me if you disagree, but from a mathematical point of view, or I shouldn't say mathematical, from an arithmetical point of view, I do not see many issues. It is B over K less G. So it's another way to define the P. And why am I doing that? I am doing that because I would like to say that if G is increasing on the denominator, as G is taken negatively into account, if G is increasing, you decrease the denominator, and if you decrease the denominator, you increase the whole ratio, namely the P, which means, and this is a conclusion I wanted to get, that a discrepancy between two P's reflects I'm going to write below a discrepancy between, with two E's, it would be better, between two expected growth rates. And it happens that the market is therefore expecting a lower growth rate for Société Générale compared to its peers. And I'm going to tell you why. Let's come back for a few seconds on the sample. Okay, I remind you what we've said. P 5.5 compared to multiples. I can see that this one is still lower, but it is only 1. If I calculated the mean, you could say that the mean is meaningfully higher than 5.5, and here you have 3.5 compared to that. We can say that Société Générale is the lowest one, because Société Générale was, till very recently, deeply involved in Russia. And in the current environment, everybody has in mind, Société Générale has had to exit Russia, to sell its Rosbank subsidiary to Russian people at a price which was not necessarily satisfactory for Société Générale, but which also means that the usual positive impact of Russia on Société Générale's income, net income, I should say, would disappear. So we have a decrease on that front. So we can say that the discrepancy between the P of Société Générale on the one hand and the P's of the peers on the other hand is a sign of a lower expected growth of Société Générale compared to its peers. Okay, so this is the first point. Example, lower P for Société Générale is equivalent to lower expected growth for Société Générale's net income or EPS. Générale's EPS. So this was for the PE, but I would also like to explain the discrepancy between two price to books. Let's do it. Let's come back to the Gordon and Shapiro. We know for Gordon and Shapiro that we have again V0 is equal to D1 over K less G. This is the customary Gordon and Shapiro formula, which means B times EPS over K less G. Well, honestly, nothing prevents me from multiplying by the number of shares. I'm going to write fully because I have enough place. Number of shares. I'm going to do it in another color so that it is easier to understand. So I'm copying and pasting what we have above. EPS1, K less G, and I'm going to say, let's multiply on the left and on the right by the number of shares. I'm going to do it, for example, in red, number of shares, and here times the same number of shares. I'm going to write more properly, but it is correct. I'm sure that everybody knows that the number of shares times the share price is the market cap. I'm sure that everybody is aware of the fact that EPS times the number of shares is very simply the net income. Net income over number of shares is EPS, so EPS times the number of shares is net income over K less G. But I think, and please don't hesitate to interrupt if you disagree, nothing prevents me from dividing by both sides by the book value of equity. Book value of equity, both sides. So I think with a low probability to be wrong, that it is the same. And there is a very good reason for this calculation. What I would like to say is that market cap over book value of equity has a definition. Market cap over book value of equity is the price to book. And you are certainly aware of the fact that, I'm going to change the color again, you are probably aware of the fact that net income over equity is the return on equity, which means at the end of the day that we have B times the return on equity over K less G, which means, and this is what I want to say, that if I increase the return on equity, which is on the numerator, I mechanically increase the price to book, which means at the end of the day that we have a conclusion. We can say now that a discrepancy between two price to book values reflects a discrepancy between two returns on, sorry, I don't know why it's appearing here, two returns on equity. If you have a higher price to book, it's because you have a higher return on equity. You may not trust me. Normally you should, because arithmetically it's been proved. If you find a mistake in the calculation I've done, please tell me. But honestly, there is no possibility of mistake here. But if you're not convinced by formulas, you will be convinced by the figures. Let's look at them. Let's come back to the table where we were. I mean that before starting the course today, I calculated the return on tangible equity. I could have done the calculation of the return on equity, but the reason why I calculated the return on tangible equity based on the formula which is in the nose sheet, okay, financial data Q15 over financial data I15, is that you look at formula, you can see where we were here, okay. We have here an EPS, okay, and this is for Q. You can see you have Q15 over I15, and I15 is a tangible book value per share. So I mean that I have simply divided these two numbers, two amounts, EPS over book value per share. It's exactly the same as net income over book value. So this is a return on equity. Okay. So what I can see now in the table which is there is that, as I've already said, Société Générale has the lowest price to tangible book value, 0.3, compared to numbers between 0.5 and 0.8. This is explained by the fact that Société Générale has the lowest return on tangible equity, 6%, compared to returns on tangible equity, which range between 7 and 12%. Okay? So what I want to say is that now we understand Société Générale has the lowest price to tangible book value because it has the lowest return on tangible equity. Okay, so let's say, example, Société Générale has the lowest, I'm going to get to do it, the lowest price to book value because it has, and you have the proof with the figures, the lowest, it has the lowest return on equity. So this is what I wanted to show regarding the multiples. I'm not going to spend an hour on that. You've already seen, moreover, the M&A peers. Okay, so you have here, you have it on the system, of course. You have here a sample of M&A transactions. In fact, I'm not interested in this kind of information. Okay, and I'm going to get rid of this. Okay, I mean that it's enough for me. I can get rid of that too. So I'm going now. I have. Okay, understand that I'm going to show more clearly the figures. To change the scale again. Well, let's do that. Let's do that. Of course, I will send the updated files after the course. Okay. So, where is it? It's here. So you can see that we have some transactions which occurred in the banking industry between 2014 and 2021. There is one transaction I know very well, which is the acquisition of Floa, which was formerly Banque Casino, by BNP Paribas. In fact, Casino was a 50% shareholder of Banque Casino, and the partner in this JV was Crédit Mutuel. And Crédit Mutuel wanted to exit, and its stake was purchased by BNP Paribas. So you can see for all these transactions what Capital IQ is naming the size. The size you can translate with a more simple word, which is the price which has been paid, and they say the enterprise value to book, but in fact the wording is wrong. It is the implied price to book value. I prefer this kind of wording. Okay, and you can see that BNP Paribas did want to make the deal and was ready to pay 1.4 times the book value, whereas for other deals, okay, regarding the sale of Erste Group Bank by Caixa, it was only 0.8. Okay, the sale by Fidelity of Virgin Money Holding, only 0.9. So you have here the multiples which have been calculated, and you can see that as usual, you have the max 1.6 times, which is there. Okay, personally, I do not know this deal. I know very well this one because I have pitched clients on this contemplated transaction in the past. This is why I have the figures in mind. Okay, so highest one 1.6, and lowest one, as we've already 0.2. I didn't see this one. Okay, which is relative to Hyporeference Bank. Okay, and you have the mean and the median. If we want to calculate the Société Générale equity value based on that. Okay, we have to keep in mind that we have here an implied price to book. I'm going to hide only for the sake of clarity these lines. You can see how easy it is. Just a second. So, to say données, plan. It doesn't want me to do it, amazingly. We can't hide them, so I will not hide them. I'm simply going to write down Société Générale book value, Générale's book value of equity. I will simply have to multiply by the mean, which is 1.1. So if you look at another file, the one I sent yesterday, the one which enabled us to start the business plan and the DDM modeling, okay, you can see that the shareholders' equity group share at the end of 2021 for Société Générale, shareholders' equity group share was 65.1. This is the book value of equity. So I'm simply going to say, well, in the file, which is, where is it? I'm very happy to be able to buy that, but it's not what I wanted to see. Okay, so, okay. So where is the file? It is here. We say 65.1. So if we want to have the equity value, simply have to apply the mean to the book value of equity. Yes, it's not properly, it's not recognized as a number. Okay, so I'm going to say that I have to enter 1.1 here, or I can say, well, let's enter 1.1. And you will see in the coming seconds that it does not correspond to the right valuation of Société Générale. I mean that we are dealing here with a sample of M&A transactions, which are mainly majority transactions, including a control premium, and regarding transactions which occurred before. On the one hand, the war in Ukraine, okay, and on the other hand, before the negative impact for some of the banks, not for all of them, of the measures which are now undertaken by central banks in order to stem inflation, namely the increase in interest rates. So what I want to say is that everything is relative to majority transactions at a time where banks were meaningfully better valued than today, because here we were before the war between Ukraine and Russia. So I mean that I applied the multiple. I could say for information only, implied equity value. And I'm going to put a disclaimer, if I may say, nota valuation based on majority transactions, including, therefore, the control premium. This is the first point I wanted to underline. Okay, and the second point is that the valuation based on transactions that were closed before war between Ukraine and Russia, which implied a huge decrease in valuation multiples. So this is what I wanted to say for the peers. You apply a multiple to the corresponding aggregate of the firm to be valued. So anyway, you can deal with a financial institution such as a bank or an insurance company. You can deal with a corporate entity in the metal and mining, in the TMT, technology, media, telecom. You can deal with whatever industry. Okay, at the end of the day, the most important point is that if you have a business plan, the best thing to do is to prepare a full valuation based on forecasted cash flows. If the firm is a corporate entity, as I said previously, of course, you can have a DCF approach. If you deal with a bank, you have to find something else. And this is what I'm going to detail from now on. And this is what we will do together in the coming seconds. Okay, of course, I will put that in the system. And before moving to the DDM approach, I would like to know whether you have questions. Maybe before moving to the DDM, let's terminate what was already introduced: identification of peers, calculations of multiples, and I should say to terminate I should have said three calculation of means, which enables to get industry multiples, and to terminate for application of the multiples to the corresponding aggregate of the firm to be valued. Firm to be valued. I think it's a no-brainer for everybody. To be valued. So having said that, I would like to say that we're here in the paragraph double I. Okay, so now 3, we're going to say DDM. So before moving to DDM, I would like to be sure that there is no question. There can be some, of course, in the chat. No question? Is it okay for the peers? We could spend 3 hours on peers, but it's enough. I think the most important part is to be able to explain the discrepancies. But I think that you have already studied that. No question? Before moving to the DDM? No? No, it's okay? I hope you can hear me. Okay, thank you, because I'm always afraid that there is a technical issue and okay. So, well, as I said a few seconds ago, we need an approach which can be based on the business plan of the firm to be valued, on the business plan of the bank. And as I've said, it's not possible to perform a DCF valuation. Moreover, we want, as I said, to account for solvency constraints, and the DDM is the right model to value a bank, and we will see that it's the same to value an insurance company. So what I want to say, and I'm going to come back to one note, is the following. First of all, I would like to say that it is impossible. I'm going to write down impossibility to perform a DCF on a bank. For the following reasons. First reason, regarding a bank, we need to keep in mind that we have no bank's EBITDA. Second reason, no bank's net working capital. Third reason, no net debt. No banks. Net debt to be deducted in order to get the equity value, try to write more properly, from the enterprise value. So the first point is that it's not possible to perform a DCF. The second point is that we want to include solvency constraints in the valuation process. And this is done thanks to the DDM. So what does DDM means? I'm going to write it down. DDM means dividend discount model. Of course, we do not focus on the expected dividends to be paid out. We are going to say that the equity value is the sum of the present values of dividends for t is equal to 1, I mean next year, to plus infinity to perpetuity, if you prefer. Please don't tell me, because it would be wrong, that, sorry, where did it go? Where did my sheet disappear? Just a second. Where is it? Where is it? Not one note, it's here. Okay, I don't know why it disappeared. So, please, n'est plus autorisé, accessoire, nous allons. Okay. So please don't tell me that it is the Gordon and Shapiro approach. No, it's not. I mean that in the Gordon and Shapiro pricing model, the growth rate of dividends, which is equal to G as growth, is the same one from next year onwards. I've never said that the growth rate was always the same one from a year to another. In fact, as for a DCF, we have several issues to be solved. We have three problems. Okay, so we are in the paragraph. Sorry, okay, paragraph. The first problem is that, well, we've decided to speak about dividends. Dividends are based on the net income. The net income has been reduced by interest. So for that reason, K is the cost of equity. The cost of equity being the risk-free rate plus the beta times the market risk premium. Here you have the market risk premium. Here you have the risk-free rate plus the beta times the market risk premium. It is, of course, based on the CAPM. K is equal to that. Right. It's the first point. The second point is that the equity value can be calculated as a sum which is broken down into two sums. We're going to say that we have the sum for t is equal to 1 to n plus the sum of the missing information. If I stop to n, whereas I supposed to go to plus infinity, I'm going to say that it is then from t is equal to n plus 1 to plus infinity. I'm sure that you've seen exactly the same for the DCF. Instead of having DT on the top, you add the free cash flow. Okay, and you know that. Here we can say that n is the number of years where n is the number of years in the business plan, in the bank's business plan, and this has a name, which is the terminal value. And I'm going to remind you what you've seen in the past, probably with Professor Alain Chevalier. Terminal value as TV. And I can say that TV, you were set for the DCF, it is the last free cash flow. We will say it is the last dividend times 1 plus G over K less G, and I do not forget to discounting that. This is the terminal value. So what I want to say is that, first of all, I have just said what the discount rate is. So I don't know if you are still there or if I exited from the session. Can you? I think I've done a mistake. I've done something wrong because I do not see myself anymore. Sharing again, but I do not see the camera. Okay, to show again, démarrer partage. Just a second. I think I've done something wrong, but I think that now it's okay. I touch a button of my laptop. Yes. Is it okay now? Can you see me again? I've done something wrong. Yes, I know. Okay, thank you very much for saying to me. So I'm coming back to, and my screen, yes, is shared. It's okay for that. So sorry for the slight interruption. So what I want to say is that on the one hand, I have said which discount rate to be taken into account. It is a cost of equity based on the CAPM. This is for K. K is the cost of equity. Aha. Right there. I don't know what I did, but anyway, it's not a major issue. So we are, no, it's okay. So wait again. So K, it's okay. K is the cost of equity based on the CAPM. First point. The second point is that we know that in order to go to plus infinity, we need this breakdown of the formula, including a terminal value, which is there. It's a second point. I would like to be able to use again the black one. And the third point is what dividend do I have to take into account? And what I was about to tell you is that it's not the dividend, which will be paid out by the firm to the shareholders. It's a theoretical dividend. I have to say, and this is what I'm going to explain, and after that we have a break, and after the break we will start the modeling on Excel, is that the dividend is, we are used to saying a theoretical dividend. I'm going to say that it is the excess equity based on an assumed common equity, on an assumed target common equity tier 1 ratio. I'm going to explain how it works on a very basic example. I mean, on a 100 basis. I do not need any calculator for that, but afterwards, we will do that with real figures on Société Générale. Okay, I'm going to explain. Let's imagine that we have, for a bank, a common equity tier 1 on the 1st of January. Let's imagine that it is, for example, 100. Let's imagine that we have a net income of the year, which is, for example, 10, which means that the common equity tier 1 on the 31st of December is, of course, 110. Why not? Okay. Let's imagine, in order to go on, that the risk-weighted assets which are provided to you are 1,000. Okay. And oh no, not well, 1,000 is fine. Okay. And let's imagine that the required, or the target, we could say, or required, as you prefer, common equity tier 1 ratio is 9%. Okay? It means that the required common equity tier 1 is 9% times 1,000. Okay, you can see where the figures are coming from, which is 90. So what does it mean? It means that the bank we are dealing with has a common equity tier 1, which is 110, whereas only 90 is required, which means that we have an excess common equity tier 1, which could be paid out to the shareholders. It's not the amount we should pay out, but which could be paid out. I mean that you have 110, whereas only 90 is necessary. So you have an excess common equity tier 1 for consideration of 20, which could be paid out to shareholders. So for our modeling, it will be the dividend, the theoretical dividend. And this is what we will do for every year. I mean, for every year, we calculate the common equity tier 1, start from the beginning of the year, 100 in our example. We add the net income, we have the common equity tier 1 at the end of the year, and you compare the common equity tier 1 at the end of the year with the required common equity tier 1, applying the required common equity tier 1 ratio or the target common equity tier 1 ratio to the risk-weighted assets. And if you have a positive discrepancy, you say that you have an excess equity. And this excess equity is the theoretical dividend to be included in the valuation process, in the background of the dividend discount modeling. And you do that for every year. And of course, we can say that if we have a common equity tier 1, which is 110, and we can say that the required common equity tier 1 will be 90, it means that if you decide to pay out 20, it means that the common equity tier 1 after theoretical dividend payment is 90. Okay, because you add 110 and you pay out 20. So you come back to 90. Okay, so you can say that on the 1st of January of the next year, the dividend is equal to 110 minus 20. I mean that you've paid a dividend for consideration of 20, which is 90. So I suggest that, except if you have questions, so it's the first question I have. Do you have questions? We are going to have a second break because I was asked by Lynn to have 2 breaks. And after for let's say 5 to 10 minutes. And just after the break, we start the modeling of the business plan of Société Générale in order to prepare the full DDM valuation of Société Générale. But before having the break, do you have questions or is it okay? Of course, this will be sent. All what I'm writing down on my laptop on OneNote is necessarily sent to you at the end. No question? We can have the break before having the last hour? Yes? So let's have the break for, let's say, 10 minutes. Okay? Thank you. So I come back in 10 minutes. So we're going to go on now. So as I said, we are going to apply all what I've said, all what I've been saying in the beginning of the course today to the valuation of Société Générale. Okay, so Société Générale is a French bank. We should say a universal bank, which is active in many countries in the world, not only in France, no more in Russia, well, I'm not going to do anything. I have already provided to you the figures of Société Générale just before the war in Ukraine. Okay? So everything will be done just on the day before the invasion of Ukraine by Russia. I have sent, as I said, several documents to you between yesterday and today. And we are going to focus now, and we will not terminate today, we terminate next time. We are going to focus on the document, the name of which is DDM valuation of a bank. And you have, as you can see, 3 sheets, and only 2 ones are useful in this model. I have already done some things. I could have done everything, but I mean that I do not want to waste time entering data. This is my only point. So it will be great, even if you know that I will send the model as is at the end of the course, and after the model is terminated, I will put it in slides, but it would be great if you could do it simultaneously. So just before the break, I said that the equity value of a bank is a sum of present values of dividends, and dividends are not the amount which will be paid out to the shareholders. The dividends correspond to the excess equity based on an assumed target common equity Tier 1 ratio. So we need the excess equity. We need to know the evolution of the common equity Tier 1 over time. Okay? And unfortunately, the common equity Tier 1 includes the net income, which is the very bottom line of an income statement, which means that we need to build the full income statement of Société Générale over 5 to 10 years in order to be able to calculate the excess equity every year, just in order to calculate the present values, to add the present values of dividends in order to have the equity value. So you can see, coming back to the sheet I sent yesterday, or I put on the system, that we are going to have a business plan till 2027. Why did I stop in 2027? I can't tell you. I could have stopped in 2026 or 2029 or 2032. Well, in fact, what I could say, but it's not a definitive answer, is that we have a business plan. We have not a business plan, we have information regarding forecasts till 2024. So we are used to having a soft landing period beyond the last year for which we have information over 3 to 5 years. I have taken 3 years because I want to limit the number of columns for the sake of clarity of what you can read on your laptops. So in fact, where do the figures come from? You can see that you have a second sheet, which is a consensus. In fact, I have hidden some columns. I have got rid of some lines. Okay, and what we can see is that we have here indeed, coming from Capital IQ, some forecasts till 2024. Again, I can reduce the size in order to increase the scale. You see, I can also reduce that. So, and I can again increase. So you can see that you have the revenues, EBITDA, as I said, well, Capital IQ is used to putting an EBITDA for a corporate entity, but for a bank, Capital IQ didn't find anything. Unamazing. So you have the revenues, you have the EBIT, not very appropriate to say EBIT. You will be definitively convinced by that in a few seconds, the earnings before tax and the net income. We need to know whether the forecasts are reliable. First of all, what is a consensus? A consensus is very simply a mean between assumptions which are done by financial analysts or by brokers, as some people are used to saying. I mean that the revenue which is there is the mean between what, for example, Morgan Stanley, Goldman Sachs, JP Morgan, BNP Paribas, Exane BNP Paribas, Kepler Chevreux, Merrill Lynch, Bank of America, and so on, have disclosed as forecasts. We want to be sure that it is reliable. I do not have time, and an investment banker doesn't have time in general to recalculate everything. But the first thing to be done is to be sure that there is no issue regarding 2021, because if 2021, which corresponds to the past, is not consistent with what we can find in the accounts, there is an issue. And it's also a way to understand what revenue means for the brokers, because, or for Capital IQ, because personally, I've never said revenue for a bank. I'm used to saying net banking income. Let's look at what we have here. So where is it? No, it's not here. Sorry, it is in the other sheet, namely BP, business plan. So you can see, if you look at the BP, that in 2021, here we're in the consolidated income statement, the capture of a page of the annual report of Société Générale, you can see that the net banking income for 2021 is 25,798. 25,798, which means that the revenue we have there is what we are used to naming in the consolidated income statement, the net banking income. And for the previous year, 22,113. 22,113. So, I mean that we've checked 2021. We can also check 2020, but we're satisfied with 2021. It is consistent with the annual report, so we can trust the forecast. This is why in the sheet BP, I have said, well, let's pick all the information from the consensus which is there. You can see consensus did 152, consensus AA 152, and so on. AA 152, and so on. We are used in the financial community to put in blue what's entered, in black what's calculated, nothing has been calculated yet, and in green what's coming from another sheet, and the green color. So that's it for the net banking income. And as we would have done for a corporate entity with sales or revenues, we're going to calculate the growth rate. Calculate the growth rate. I take the amount of the year divided by the amount of the previous year minus 1. You can say that is a change in net banking income over the net banking income in 2020, but if you do that, you need to open and close brackets. If you do not want to open and close brackets, you take the amount of the year divided by the amount of the previous year minus 1. And of course, it's not 0, it's a percentage. It is 16.7%. And I can extend beyond 2024. As for many other firms in many other industries, we have a huge increase in 2021 because we have a basis effect. I mean that everybody knows that 2021 was the year of the global lockdowns. So I mean that we start from very low. I remind you that if you increase from 100 to 101, you increase by 1%, whereas you have added 1. If you increase from 10 to 11, you also add 1, but you increase by 10%. If you increase from 1 to 2, you increase by 1, but it is 100%. This is a basis effect. Well, 2022 will not be a very good year, mainly because of the exit from Russia. Having said that, you can see that in 2024, you have a growth rate which is 4.9%. Okay. And I have to tell you that we want to perform a DDM valuation approach. If we have a DDM valuation approach, okay, we need to have a breakdown between the sum of the present values over the n first years plus the terminal value. Okay? And what I want to say is that 2024 can't be the last year, because 4.9% is a huge growth rate. Maybe that in Asia, it's not an impressive growth rate, but for European people, 4.9% is really huge. I mean that before the crisis, before the problems, which is another topic of inflation, which has to be stand, we're saying that the expected growth rate of the economies, the expected GDP growth rate was below 2%. So if we want to be a bit aggressive, the maximum growth rate we can account for is 3%. Okay? I'm going to put here 3%, which will be looked upon as a normative growth rate, which is that of the last year of the business plan, and which will be that which will be taken into account in order to calculate the terminal value. It is a small g of the terminal values formula. So what I want to say is that we can be very comfortable with a 4.9% because it's based on information which is not coming from us. The information is that of brokers, of financial analysts. It's a vision of the market. So it can't be criticized if you say the market is anticipating 4.9% growth rate, or was anticipating before the beginning of the war between Ukraine and Russia. It can't be criticized. If you say that the perpetuity growth rate is 3% based on expected growth rates of GDPs, you can't be criticized either. So we can feel comfortable with 4.9% as we can feel comfortable with 3%. The problem is what's going to happen in between. And in between, the best way to proceed, and it's probably what you've done when you studied the DCF approach, is to have a linear phasing. Okay? And I have already sent to you the beginning of the slides, just in order to have an idea of the drivers I'm going to include. And of course, many things are missing, including firstly the tables, because this is what we are preparing. If you look at the slides I have sent, you see slides of Société Générale. Okay, you can see that again for 2022 to 2024, we use the consensus of brokers. This is what's been done. And for the soft landing period, 2025-2027, we have, as I've just said, a soft landing period with a linear phasing of the net banking income growth rate from 4.9% in 2024 to 3% in 2027. Look at what we have, 4.9% to 3%. And we want a linear phasing. So I'm going to enter the formula to have the linear phasing. What does it mean? It means that the difference between the growth rates from a year to another will always be the same one. What do I mean? I mean that here, I'm starting from the 4.9%, which is there. And I'm going to say that I want the difference between 4.9% on the one end and 3% here on the other end to be spread over 3 years. 1, 2, 3. So the difference between 4.9 and 3%, namely 1.9%, is spread over 3 years. And of course, I will feel like extending this formula or copying and pasting it on the right, which implies that I need to put some fixed references on the 4.9 minus 3%, which means dollars. And I would like to tell you that, sorry, I made something wrong. So again, is equal to that minus the difference between 4.9% and 3% spread over 3 years. And of course, it's not zero, it's a percentage at the one we have here. Sorry. And if you want to extend the formula, you need to put some dollars. And I have to tell you that if you have a PC, you can type on F4. And if you are on a Mac, you can type on Command T. If you do not trust me about the linear phasing, you can calculate the difference between 4.3% and 4.9%. Of course, it's not zero. It is this number, and I can extend, and you can see that it is always the same difference, which means that we do have a linear phasing. So you can see the formula for the linear phasing, and then if we know the growth rate for every year, we can apply it to the net banking income of the previous year. So we can say that we have 27,392 times bracket 1 plus 4.3%, which is just below. And of course, you can extend the formula or copy and paste as you want till the end. And I can tell you that if you get 30,482 in 2027, no use checking the intermediary outputs. They are necessarily correct. So, having said that, we are going to go downwards because we want the net income and we are not there so far. So, if we want to go on, here we have the gross operating income. In fact, it's not what you can read in the consensus of brokers. Let's look at 2021. We have here a so-called EBIT. But again, I'm not familiar with EBIT for a bank. 8,200 208. Let's go back to the income statement. 8,208. 8,208. It is a gross operating income. This is a common wording in the banking industry, keeping in mind that EBIT does not exist. It exists only for capital IQ. So it is a gross operating income. And of course, as we've identified and found the same amount in the accounts of 2021, we can trust capital IQ and extend the formula to the next years, has been done here. What do we have in between? Between the net banking income and the gross operating income, we have the operating expenses. Is the difference, for example, in 2020, between 22,000 and 5,000. But I want to sign negatively the charges and the expenses. So if I want to have a negative amount because it's a charge, because it's a cash outflow, instead of putting minus bracket 22,113 minus 5,299, I can simply say it is a gross operating income minus the net banking income. And of course, it is correct. If you take this one plus algebraically this one, 22,000 minus 16,000, you can see that you get 5,000, which is exactly what we have here, 5,399, which is there. And of course, you can extend till the year 2024, for which you have on the one hand the net banking income, on the other hand the gross operating income. And now we need to go on beyond 2024. And it happened that if we were having for a customary corporate enterprise, corporate firm, we would say, let's calculate the EBITDA margin. But for banks, we're not calculating any EBITDA margin because we've seen that even Capital IQ does not know what the EBITDA of a bank is. We are going to calculate what we are used to naming the cost to income ratio. The cost to income ratio is a cost. I could have written down operating costs, so it will be more self-explanatory, over income. And we would like this ratio to be signed positively. We are never saying the cost to income ratio is minus 70% or minus 80%, or it is 70 or 80. So as we are going to base the calculation on a negative amount, I'm going to say minus, just in order to get rid of the minus which is there. So cost over net banking income. You can see that it is 70. I'm going to write it down here. Net banking income, NBI. Cost to income. And I can extend till the end, till 2024. Cost to income. Cost, line before, line 4, column B, over income, line 2. So you can see that unamazingly, this ratio is decreasing over time, which means that the costs relative to the income are decreasing. So you can see that unamazingly, 69, 67, 63. Will it go on decreasing in the future? My answer is probably yes. What will be the next cost to income ratio? I have no idea, no external analyst has an idea on that. And I'm not sure that the CFO of Société Générale knows what the new target will be. So what we can say that it will probably be improved, namely it will probably decrease, but we don't know exactly what will be the next step. So the best thing to do is whether to say that it will probably be less than 63, and we're going to keep 63. Okay, we can say that we are aggressive when we say that we are conservative. So we keep the 63% we had already in 2024. And if we know the cost to income and we know the income, applying the cost to income to the income, we have the cost. So we can say minus 63% applied to the income, to the net banking income. And of course, we can extend the formula again till the end. So that's it for the gross operating income. Then you can see that we have, from now on, the net banking income till 2027 and the operating costs. So we can calculate the gross operating income, which is, of course, the net banking income minus the operating costs, which have already been signed negatively, so plus algebraically the negative amount of operating costs. And of course, I can extend the formula till the end. And we like to be sure that it's still okay for everybody. I'm going to go back just to check whether I have questions on that. It's okay? Can go on? No question? So I'm going to go on. So I'm coming back here. And there is a cost of risk. Yes. The cost of risk, which is the next gross operating income, cost of risk. So you can see 2020, it was 3,306. And more importantly, for 2021, the cost of risk is 700. So I have already entered the 3,306 for 2020 and the 700 for 2021. Okay, so this is what I wanted to say. And having said that, if you look at the structure of the income statement of a bank, namely here the Société Générale, if you say, well, I have the gross operating income minus the cost of risk, I get the operating income. I'm going to say that I have the operating income. Operating income, which is the difference between the gross operating income and the cost of risk, which has already been signed negatively. So of course, there's a slight issue regarding the formatting, okay? And I can extend, and you have the operating income in 2021, which seems to be 7,508, and you can see 7,508. So that's correct. Then you can see that you have net income from investment, which are accounted for using the equity method. It's not a huge amount. We are speaking about 6 million. I mean, that for me, it would be a great amount, but for a bank such as Société Générale, it's not a huge amount. Net income and expense from other assets, 635, and value adjustments of goodwill, minus 140. Everything has been entered here. That would not waste time copying and pasting amounts. So what will the net income from investments be in the future? Honestly, as an external analyst of Société Générale, I have absolutely no idea. What will the net income from others be in the future? No idea. Goodwill adjustments? No idea. So I mean that when you have such amounts, which are not very important, we have no way to assess what their value in the future will be. The best thing to do is to say, let's highlight the amount and let's say that it will always be the same in the next years. It will always be 6 for net income for investments. It will always be 635 for net income from others. And it will always be 114 for the goodwill adjustments. So we are very happy to have that. And of course, if we know the gross operating income, the cost of risk, and therefore the operating income plus and less the miscellaneous net income for investment, net income from others, goodwill adjustment, well, we have the earnings before tax. We can calculate the sum, as I'm doing, of operating income plus net income from investments plus net income from others minus goodwill adjustments. We have the earnings before tax, 1,400, and I can extend, and the year which is important for us is 8,035. Okay, let's see, 8,035 after a year 2020, where it was 1,400. So 1,400, then 8,035. Exactly what we have. And if we look at what you have in the consensus for 2021, earnings before tax, you can see that you have indeed 8,035. 8,035. So we've checked in the previous sheet that it was fully consistent with what we have in the accounts. So we can trust what we have found in the consensus of brokers. And we can say that from 2022, 2023, 2024, we can account for the consensus of brokers. You can see here, we have this amount, then this one, then this one, then this one, just to terminate with 8,135. Okay, 8,135. So it can be trusted. So now let's calculate the operating income. Well, the operating income plus the net income from investments, plus the net income from others, minus the goodwill adjustment has to be equal to the earnings before tax. So you have X operating income we're looking for plus miscellaneous elements is equal to 6,101. So it means that the operating income is this amount minus the sum of these three amounts. It's only a matter of formatting. Okay, and we have, in that case, 5,664. And we can go until 2024. Just in order to reconcile the operating income. I hope it's okay for everybody. I'm going to check whether you have questions or not. No question? Don't hesitate if you have some, because again, I'm going to come back to where we were, where it's not possible for me to see the chat. So let's come back to Excel. Okay. And well, if we come back for a few seconds to the consolidated income statement, we can see that gross operating income minus cost of risk is equal to operating income. Gross operating income minus cost of risk is equal to the operating income, which does correspond to what's been done for the year 2021. And we got exactly the right amount compared to the official accounts in the annual report. So if gross operating income minus cost of risk is equal to the operating income, it means that the cost of risk is the difference between gross operating income and operating income. But as I want the cost of risk as a charge to be signed negatively, in order to prevent from opening and closing brackets, I'm going to say we take the operating income minus the gross operating income. No, again, I repeat, it is gross operating income less operating income, but as I want it to be signed negatively without having to open and close brackets, I say operating income minus gross operating income. And you have the cost of risk, which is there. Sorry. And of course, what's been done here, operating income minus gross operating income, enough to have cost of risk, which is negatively, can be extended to the next years. Well, that's a good point. And now we need to go on, I mean beyond 2024, for the cost of risk. The second point is that, unfortunately, we do not know from 2025 onwards, I should say we don't know yet, from 2025 onwards, the operating income. We don't know it. So we can't extend the formula. The first point. The second point is that we need a driver to assess forecasted amounts for the cost of risk. The cost of risk, I forgot to say what it is. I forgot to say, but you probably know it because I've been said that you've studied the accounts of banks. The cost of risk is a wording which is specific to banks. If it had been an entity in an other industry, we would have said provisions. Okay, I mean that here we have increases in provisions on receivables. Receivables being the most important asset in the balance sheet of a bank. I mean that I know that a bank may have many activities such as lending, such as asset management, such as factoring, such as leasing, such as custody, or more generally, asset servicing. I'm probably forgetting activities, but anyway, if you take a huge bank, such as Société Générale, BNP Paribas, Crédit Agricole, Unicredit, Intesa Sanpaolo, and so on, okay, the most important asset corresponds to receivable because the core business of a bank is always to grant credit to retail clients and to corporate clients. So I mean that the cost of risk depends on the loans which have been granted to clients. And the best indicator for loans, without having to simulate the loans every year, is the risk-weighted assets. I mean that if you grant a loan you undertake a risk. I mean that risk-weighted assets are a percentage of loans. For example, in the consumer finance business, the weighting coefficient is generally 75%. Well, we have the risk-weighted assets for 2020 and 2021. So we are going to see the evolution of the risk-weighted assets year over year, and it will enable us to index the cost of risk on the risk-weighted assets. We're speaking about cost of risk, and we have here the risk-weighted assets. So it seems to be consistent. Where do the two figures here coming from? They are in blue. They have been entered by myself. And look, here we've seen that several times. We have the consolidated income statement. And then we have another table, which is found also in the annual report, showing the solvency aggregates and ratio. You have the common equity tier 1 capital. I'm used to saying the common equity tier 1 without adding capital. But you can say common equity tier 1 or common equity tier 1 capital, which is based on the shareholders' equity group share. Okay, you can see that the minority interest, I say, interest, that is the same, has been added. You can see that the dividends to be paid out have already been deducted. Interest on subordinated debt have also been deducted. Well, at the end of the day, we can start from the common equity tier 1, which is 49.8 after 47.3 in 2020. Sorry, I was looking at, I was not looking at the right line. I was speaking about common equity tier 1. We'll come back to that in the 2 coming minutes. I was supposed to be focused on risk-weighted assets, 342, 363. 352, 363. Please keep in mind that when we deal with the income statement, we have amounts in million euros. But when we deal with solvency figures, we deal with amounts in billion euros. So we have to say it, and when we mix the amounts, we have to be very careful. Okay, at this stage, we only deal with the risk-weighted assets, which are in billion euros. So 352, 363. Again, 352, 2020, 363, 2021. So we can calculate, as I did for the net banking income, the growth rate. So we take the amount of 2021, we divide by the amount of 2020 minus 1. Of course, it's not 0. Of course, it is a percentage, which is 3.1%. And from 2022 onwards, I'm going to follow the trend, which is coming from the brokers for the net banking income growth rate, and based on the soft landing, which has been taken into account beyond 2024, which means that from 2022 onwards, we take the growth rate of the net banking income. If there is a decrease in the net banking income, it's probably because there is a decrease in the new loans and therefore a decrease in the risk-weighted assets. So I can index from 2022 the growth rate of risk-weighted assets on the growth rate of net banking income. So you can see that I am taking the percentages which are above, and I can extend till 2027. You can see where it's coming from. For example, this one, E3, 5.3%. Okay, and at the end you have the 3%, which is the assumption, the customary assumptions taken into account here. I don't know exactly what the expected growth rate on the long run of Vietnam is. If it is very high compared to Europe, as China, for example, can put 5 or 6 or 7% instead of 3%. It's not an issue. So we have the growth rate. We have the risk-weighted assets of the previous year. We apply it. So we take the risk-weighted assets of 2021 times bracket 1 plus the growth rate, which is -1 for 2022. And of course, we can extend the formula till 2027. And you have the risk-weighted assets for every year. And we are going to index, and we'll stop after that for today, the evolution of the cost of risk on the evolution of the risk-weighted assets. That will be the last calculation for today. We're going to say that the cost of risk can be put in percentage of risk-weighted assets. I want this percentage to be positive, so I'm going to put minus just in order to get rid of the minus in front of the cost of risk over the risk-weighted assets, which is there. But of course, I need to keep in mind that we are in billion euros. So I have to multiply the denominator by 1,000. Okay, it's better that way. And I can extend till 2025. Always minus, in order to have a positive amount, the risk, the cost of risk, which is in F8, over the risk-weighted assets, turned into million, because we have billion euros here, so the denominator being multiplied by 1,000. I'm going to put cost of risks between brackets for the sake of consistency. And I said that I would stop after the cost of risk. So I'm simply going to terminate the line regarding the cost of risk. So I'm going to do what I did for the cost to income ratio. I said for 2024, 63%. Can't be criticized, is based on brokers' assumptions. Will it be better in the future? Probably yes. At which level? I don't know. So the cost of risk is the same. We have 0.7% of the risk-weighted assets. What will it be in the future? No idea. So we're going to keep this ratio beyond 2024. We're going to say that it is always equal to what's been forecasted by brokers for 2024. So it will always be 0.7% beyond 2024. And to terminate, if we know that the cost of risk represents 0.7% of the risk-weighted assets, which are known, we simply have to apply. So first of all, it is a charge. The cost of risk is a charge. It's a kind of provisions on loans which have been granted, on receivables, on doubtful loans, as we are used to say in the banking universe. So we put minus because it's a charge, 0.7% times the risk-weighted assets, which are there. But of course, we have to keep in mind that here we are in million and not in billions. We have to multiply by 1,000 just in order to have consistent figures. So for today, we are going to stop here. We've done most of the job because we can see that we are not very far from the net income. All the beginning has been done. Okay, so of course I will upload on the Canvas system this model. Okay, and before stopping, I would like to know whether you have questions or if it's okay for today. Keeping in mind that we are going to go on next Wednesday afternoon. Afternoon for me, but yes, afternoon for me, so evening for you. Sorry, I'm not used to being in line with eastern part of the world. I'm more used to having that with the US. So, do you have questions, or is it okay for today? Of course, I'm going to send that. I'm going to send what I wrote down. I'm going to on OneNote with my pen, you see, and all what I did on Excel. But before stopping, do you have questions? No question? It's okay? No? Anyway, you have the right to look at what I'm going to send and ask questions at the beginning of the next course. So please don't hesitate, of course. No? No question for now, okay. But if there are some, don't hesitate. So we stop here, and I say to you, have a good evening, good night, maybe. I don't know what time it is exactly for you, and we will go on Wednesday afternoon. Thank you very much for your attention. Bye-bye. And I'm sending what has to be sent. What was announced, I should say. Files. Upload. This one. And this one. Replace. Yes, replace. So that's it. And now where is it? Where is this one? Yes. Sous forme PDF. Ah, mais je ne veux pas faire d'Outlook, moi. Exporter plutôt. Exporter. Ouais, c'est bien ça. Vietnam.
You are currently the only person in this conference.